Ladies and gentlemen, Matthews here from your FOREX traders. I hope you're doing great. So in this video, we're going to discuss what is important between trading psychology and strategy when it comes to the market. So stick around and watch the rest of the video. Alright, so we've seen a lot of people, a lot of debates going on the internet right now about what is important. Is it psychology or is it trading strategy? So when it comes to trading, we have to understand that all these categories, whether risk management, whether trading psychology, whether trading strategy, we have to understand that they all have a part to play. However, to determine which one is more important, we have to look at different things for us to come to that decision, right? So you have to understand that in order for you to win in any particular game, in order for you to win or to win in a long term in any particular industry, you have to have an edge, right? And that edge is the strategy. You need to have a proven strategy which you back tested and forward tested. That truth can never be overemphasized. Regardless of how good your psychology can be, if you have no edge, then you can't win long term, right? And that's my stance. Therefore, the first thing that you have to do as a trader is develop a trading strategy. You have to have a trading plan. Okay, before you even start looking at psychology and risk management, you have to figure out how to pick your trades. How is it that you're going to be taking your trades? Is it going to be technical? Is it going to be fundamentals or sentimental analysis? Right? So before we start talking about psychology, we have to make sure that we understand how the market moves and when the market has given us an opportunity to actually get involved. Without those things figured out, no matter how good your psychology is going to be, you're just going to be gambling, of course, hoping that the market is going to go in a direction. But when you have an edge, when you have this strategy, and this strategy has been back tested and forward tested, it's going to be different because you have the data that shows that you can be profitable over the long term, right? I can give you an example, right? In football, for example, someone is about to take a penalty, right? Soccer or football, I don't know what you call it in your country, right? Someone is about to take a penalty, right? They want to consider someone who's good psychologically, right? Who is able to handle more stress. The first thing they're going to look at is who is technically equipped to take this penalty, right? They don't just choose anyone who's good in terms of psychology, managing the anxiety and all that. Of course, that is extremely important. That's actually a very, very important attribute to have when it comes to taking a penalty. But the first thing they're going to consider is their ability to take a penalty. That is extremely important. That factor cannot be excluded. After they have figured out who is good in taking that penalty, that's when they're going to look at, okay, can he handle stress? Can he handle anxiety? Because that is extremely important as well. Because no matter how skilled you are in terms of taking that penalty, guess what? If your psychology is a mess, if you have anxiety whenever you're about to take a penalty, guess what's going to happen? You are going to end up missing that penalty. Not because you're not skilled, no, but because your psychology is not in the right place. That's where psychology now gets rid of all this. That's where psychology superimposes everything else. Yes, you can be skilled technically, but if your psychology is a mess, you can't win long term. You can have the 90% win rate strategy, right? Proven and back tested, but after taking 2 or 3 losses in a row, you get to have FOMO, you get to go on tilt. Guess what's going to happen? You can still lose even if you win 90% of the time, because on that one trade that you're going to lose, guess what? You're going to lose more than what you can afford to lose on a trade by trade basis, thereby blowing your whole account or violating a challenge account. Why? Because your psychology is not in the right place. That's the reason why we see others siding saying psychology is most important. Psychology is most important, yes, but after having the right strategy, that's when you can now start working on your psychology. So you can't start blaming your psychology when you don't have a proven strategy in the market. It doesn't work like that, guys. It doesn't work like that. You have to have an edge in the market. And only after that is when you're supposed to now start focusing on your strategy and risk management. Before that, you can't blame your strategy, your psychology. You have to work on your edge. You have to have a proven edge in the market that shows that you are consistently profitable in the market. After that, that's when you can now start working on how to handle losses, because losing is inevitable when it comes to the market. You are going to lose, and that's a fact. Therefore, you're supposed to learn how to manage those losses. You're supposed to learn how to handle your emotions when losses start coming. Because if you don't do that, you are going to lose every time. Because psychology will be more important at that particular time than everything else, right? Your psychology is going to be more important than your risk management, than your strategy. Because at that particular point, we have what you call the amygdala hijack. Your prefrontal cortex stops functioning, and then you're going to just go into tilt, and then you stop thinking. And that's the reason why we encourage you to have a strong psychology. You have to be self-aware. Therefore, you need to do things like meditation and practice things like mindfulness, because these are things that are going to help you remain calm under pressure. It's very, very important, because without those things, you can't be consistent long term. And that's the reason why I'm a fan of Mark Douglas, the work of Mark Douglas. May he so rest in peace, because that was the guy that actually changed my life when it comes to psychology. Because I had a strategy, but I was always anxious. I was always stressed after taking a loss, right? But when I came across his work, it revealed to me that, I actually don't have to know what's going to happen on the next trade, because the outcomes are random. The outcomes of individual trades are outside my control. Therefore, I should not even worry about it. Provided my strategy has been proven to work, I have to just keep on executing. Right? I have to keep on executing as long as I have and trust my strategy. And that's the reason why I always talk about this, because on a trade by trade basis, the outcomes are random. And that's the reason why I have these written principles right here by Mark Douglas, the 5 fundamental truths of trading and the 7 principles of consistency. Let me read them to you so that you can understand why psychology is very important when it comes to the market, especially. Number 1 fundamental truth of trading: anything can happen. I've always talked about this because literally anything can happen. You can have the best setup right here. You can have the right setup, meets everything, A+ setup. You take that trade. There can be some random news that comes out and the market goes against you. Anything can happen. And you have to understand that as a trader. Anything can happen. And because anything can happen, you have to predefine the risk every time. Extremely, extremely important. And number 2, you don't need to know what's going to happen next to make money. Why? Because anything can happen. The market works in terms of probability. Therefore, there is no need for me to try and know what's going to happen next, because anything can happen. I don't need to know what's going to happen in the market. All I have to know is how much am I willing to lose on this particular trade. That's all I have to know. Provided I have an edge, a back-tested edge that has shown consistency, then I just have to focus on taking the next trade. Number 3, there's a random distribution between wins and losses for any given set of variables that define an edge. Okay? There's a random distribution between wins and losses. Let's say I have a 50% win rate. Does that mean that I'm going to have 5 losses in a row and 5 wins in a row if I have a 50% win rate and I'm taking 10 trades? No. What it simply means that over a series of trades, I have a chance of having 50% wins and 50% losses. However, I don't know in what sequence those losses and wins are going to come. Therefore, it tells me that I'm supposed to be able to predefine my risk and actually accept the risk of every trade, because guess what? If you look at the statistics, if you have a 50% win rate, you have 90% of having 6 losses in a row, even if your strategy has a 50% win rate. And that's the thing you have to understand as a trader, because if you don't get that, you're always going to be switching strategy after taking 5 losses in a row because you think the strategy doesn't work. That's where psychology comes in. And then, what is an edge? An edge is nothing more than an indication of a higher probability of one thing happening over another. It's just a probability of you taking a win over a series of trades. It's not, doesn't mean that it's guaranteed that you're going to make money. It's just a higher probability of having a win over a loss. And this is not on a trade by trade basis. It's actually over a series of trades. And that's a point that we have to understand. It's not on a trade by trade basis, but rather on a series of trades. And that is extremely important to understand. And the most important actually point here is every moment in the market is unique. Every moment in the market is unique. You can get the same trade today, take the same setup today in the morning, have a win. You can take the same trade again 5 minutes later and still take a loss, because the market is always unique. No matter how similar the setup might be, the outcomes are random. And we need to understand and internalize that fact if we are going to be consistently profitable in the market. And those are the 5 fundamental truths of trading. Let's look at the 7 principles of consistency according to Mark Douglas. And these are the things I actually read on a frequent basis, and I've actually internalized them because I understood how important these things are when it comes to trading in the market. Alright, so the number 1 is I objectively identify my edges. Meaning, whenever I'm in the market, I'm objectively looking for my setup, and as long as my setup appears, I'm obligated to take that particular trade because it meets my criteria. Not that I think that trade is going to win, no. Because I understand that anything can happen from the fundamental principles right here. But I understand that I have to objectively identify my edge, my strategy every time if I'm going to be consistently profitable. Number 2, I predefine the risk of every trade. Why? Because anything can happen and every moment in the market is unique. Therefore, I should not be confident after taking a win thinking that the next trade is going to win because I've taken another, the previous trade was a win. No, I have to predefine the risk of every trade because the market is random and there's no way for me to know in advance if a trade is going to be a winner or not. And that is extremely, extremely important. Number 3, I completely accept the risk, or I'm willing to let go of the trade. Before you take any trade, accept the risk in advance. Calculate your risk using a position size calculator, and then accept the risk of that particular trade not working out, because there's actually a chance that it's not going to work out. Therefore, you have to understand that in advance so that you avoid the emotional trauma of you taking a loss, because you have unrealistic expectations that you've set on that particular trade. So if the trade goes against you, guess what? You're going to be emotionally pained because you expected it to be a winner, and that is extremely very dangerous. Number 4 is I act on my edges without reservation or fear. Meaning, whenever I see my setup appearing, I have to take that trade because I have no idea which trade is going to win. However, I know that if I keep taking my trades, there's a higher chance that I'm going to do what? I'm going to be profitable according to my strategy, because I have the statistics that show that I'm consistently profitable in the market. Therefore, even if I've taken 3 losses in a row, I'm going to take the next trade because I don't know the outcome of the what outcome will be on that particular trade. I have no idea. Therefore, I have to take the trades that the market brings to me every time, regardless of the outcome of the previous trade. And number 5 is I pay myself as the market makes money available to me. So you have to find a way of paying yourself. Are you going to be taking partials? Are you going to be trading stop loss? Whatever is suitable to you, find a way of paying yourself. Why should you do that? If it doesn't really come to you already, it's because anything can happen. The market can go all the way to 1 to 20 risk to reward ratio and still come back and take you out. That's what the market does sometimes. So you have to find a way of paying yourself as the market is making money available to you. Number 6, and one of the most important points right here, is I continually monitor my susceptibility for making errors in the market. So you have to be self-aware enough to know when you're not supposed to trade. If you know you're emotionally not there, don't trade, because you are likely to make errors. You're going to make risk management errors. Okay, don't trade when you're upset, when something has happened in your life that you're not in the state that you're supposed to trade. Don't trade. The market is not going anywhere. The market will always be here. So wait until you are in the state where you are able to trade, then you can come around and start trading. The last one is I understand the absolute necessity of these principles of success, and therefore I never violate them. I understand the necessity of these principles of success, and therefore I never violate them. These are the rules that you're supposed to have stuck on your wall. Make sure you have them somewhere, because they are extremely important and they're going to keep you grounded in the market and to help you become a consistently profitable trader. Alright, so that is extremely important, guys. So I thought I would actually come to you guys and share these things. I know I've shared some of them in the past, but I thought I would come to actually share with you again. Alright, so I hope you found value in this video. If you have, make sure you subscribe and like the video, comment in the comment section. If you need to talk to me, the links are down in the description. If you need our course, the first link in the description gives you access to our M&F mentorship community, and it comes with lifetime mentorship and lifetime signals whenever you purchase our M&F mastery course. It comes with all those benefits, so make sure you check it out. And you guys, until next time. And we're about to hit 3,000 subscribers right here on YouTube, so you guys help us reach those numbers. Until next time, goodbye.